Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today we are diving into a filing from Red Cat Holdings, and let me tell you, it involves debt, warrants, and a whole lot of financial maneuvering. It is going to be a wild ride. So Red Cat Holdings just made some changes to a deal they had with Lind Global Asset Management. Basically, they needed some cash, so they made a deal. Now they are tweaking that deal. It is like they are renegotiating the terms of a loan. Let's see what is happening. On April 9th, Red Cat Holdings changed their original deal with Lind Global. This involved a senior secured promissory note and a warrant that were first agreed upon in February of 2025. Think of it as rewriting the rules of a loan agreement. Back in February, Red Cat received $15 million from Lind. In return, Red Cat gave Lind a secured promise to pay back $16 a share for the next 5 years. This right to buy stock is called a common stock purchase warrant. It's like getting a loan but throwing in some potential future ownership for the lender. The original agreement had some rules. First, if Red Cat issued new shares of stock at a lower price than what Lind could convert their debt for, Lind's conversion price would also drop. This is called a price reset provision. Second, if Red Cat raised more than $15 million from selling new securities, they had to use 20% of that money to pay back the debt to Lind. This is the offering proceeds provision. Finally, Lind had the right to buy up to 20% of any new securities Red Cat issued. This is called participation rights. The warrant also had a similar provision where the exercise price would adjust if Red Cat reset a lower price. It's like Lind was trying to protect their investment from being diluted or lessened by new stock offerings where originally the debt was due in February of the following year. That is 2026. Lind could convert the debt into stock at a conversion price of about $16 per share or at a repayment share price, which was 90% of the average of the lowest stock prices in the weeks before conversion, but it wouldn't go below a certain floor price. Lind could only convert a maximum of $1.65 million each month unless Red Cat agreed to more. Also, if Lind wanted to convert when the repayment share price was lower than the conversion price was lower than the conversion price, which was 90% of the average of the lowest stock prices in the weeks before conversion, but it wouldn't go below a certain floor price. Lind could only convert a maximum of $1.65 million each month unless Red Cat agreed to more. Also, if Lind wanted to convert when the repayment share price was lower than the conversion price, Red Cat could choose to just pay Lind the conversion amount plus a small bonus in cash instead of giving them stock. It's a complicated way of saying Lind had So what changed? In exchange for Lind giving up some of their protective rights, the deal was changed. First, the debt amount increased to about $18 million. It is like they added more to the loan. Second, the price at which Lind could convert the debt into stock dropped to about $9.50 per share. That is like a sale on potential stock. Third, the price for Lind to buy shares using their warrant also decreased to about $7.50 per share, another sale. Fourth, the due date for the debt was pushed back to May of 2026. More time to pay. Fifth, Red Cat could now choose to pay up to half of any conversion amount in cash plus a small bonus instead of issuing stock if the stock price was lower than the conversion price. More control for Red Cat. Finally, the price reset provision, the offering proceeds provision, and the participation rights were temporarily removed until mid of April. If you want to see the full details, you can check out Exhibit 10.1, the first amendment to the Senior Secured Convertible Promissory Note and Warrant. Now, let's zoom out a bit and see what all this means. Red Cat Holdings essentially renegotiated their debt agreement with Lind. They gave up some potential stock value by lowering the conversion and warrant prices. At the same time, they gained more flexibility in how they repaid the debt and temporarily got rid of some restrictions on issuing new securities. What does this tell us about Red Cat? Well, it could mean a few things. They might be expecting their stock price to stay low, making the lower conversion price acceptable. They might need to raise more money soon, and getting rid of those restrictions temporarily could help. It also shows they are willing to dilute their existing shareholders by issuing more shares at lower prices to keep the company going. On the other hand, it could be a strategic move to free themselves up for a limited time to take advantage of a time-sensitive opportunity that will increase the value of the company in the long term. It's all about balancing risk and reward, and Red Cat seems to be betting on their ability to turn things around. Now for my final thoughts. Red Cat Holdings is definitely in a challenging position. They needed to sweeten the deal for Lynn to get these changes, which means they likely didn't have a lot of negotiating power. However, the temporary removal of those restrictions gives them some breathing room. If they can use this time wisely to improve their financials or secure new deals, it could pay off. But if they can't, they might find themselves in an even tighter spot down the road. Ultimately, this filing is a snapshot of a company navigating a complex financial landscape. Whether they succeed or not will depend on their execution in the coming months. Thanks for watching Corporate Decoder. If you enjoyed this breakdown, give us a like, drop a comment, and subscribe for more insights into the world of corporate filings. Until next time, keep decoding.